Family, you made it. Today we're talking about how to pay yourself as a startup. Look, by the end of the video, you'll know when to pay yourself, how much to pay yourself, and a very simple process to setting this all up and making it easy for you. Let's dive in. The one thing I need you to understand, right, is that it's a 5-step process, 5 simple steps to paying yourself properly. The first step is asking yourself, can the business actually afford to pay you? The second step is asking yourself what your payment options are. Next, how much is actually safe to pull out of that business? 4, how do you even set it up to pay yourself? And last but not least, what mistakes you need to avoid. We're going to be covering all of this step by step right now. Step number 1 is, can you actually pay yourself? Here's the thing. Your business eats first and you eat second. You flip that around and you don't have a business any longer, okay? Right? You want to cover your business bills first. So one thing you need to do to start this off is to list your monthly operating expenses. You have to know your numbers. That's your rent, your tools, your ads, your your salaries if you have them, right? All of these expenses, right? Whatever they are, list them, write them out. Then look at your bank account. If you don't have enough to cover these operating expenses, then you don't pay yourself yet. It's really that simple, because founder pay only starts once business bills are secure. But I have something that's going to help you with this. And it's called the 1-month buffer rule. And it's that you always leave at least, key here, at least 1 month of expenses in the business. So if OPEX, that's operating expenses, equals $20,000, then you keep $20,000 in the bank account, at least. This protects you from at least 1 bad month. And above that, congratulations, you have money available for reinvestment or for your pay. All right, now let's see what's left for you. What's left for you is your cash minus your business bills minus your buffer, right? That equals your check. So an example is $60,000 in the bank, $20,000 in bills, $20,000 in buffer. That's $20,000 available to pay yourself using the 1 buffer rule. And that 20K is split between founder pay and potentially scaling the business. That's a choice you have to decide, but we'll talk about that a little bit later. So here's an example, just an example from one of my businesses, right? Here we have what's in the bank account. Here we have the operating expenses to run that business per month. I use operating capital of 1.5 months, which leaves me with $219,000 to pay myself for the month. All right. And that's using the 1 buffer rule of at least 1 month operating expenses. The rest you get to keep. So how do you actually take the money out of the business? What are the best ways to do it? Let's dive in. There are 3 ways to pay yourself. One is the owner's draw, one is distributions, and one is salary. Okay. Let's look at the owner's draw. Owner's draw is simple, right? It's you transfer money from your business to yourself. All right, from the business bank account to your personal bank account. That's all it is. And this is common in sole proprietorships, partnerships, and LLCs. Unless the LLC elects to be taxed as a corporation, which we'll get to. Then there's no payroll needed. You just move the cash. Wire transfer, ACH transfer, however you like. Now, the tax effect on this is that the drawer itself isn't taxable when taken, but instead the owner pays income tax and self-employment tax on the business's net profit. And that's whether you take the profit out or not, right? You need to know that this is taxed on the net profit of the business. All right, let's look at distributions. A distribution is just an official profit payout to the owner, right? This is used by LLCs, partnerships, based on your operating agreement, and also used by corporations, right? S corps take distribution, C corps dividends. And you're paid based on your ownership percentage, right? So if you're a single member, say LLC, well, it's only you, right? So you get 100%. If you're a multi-member LLC, maybe you have equal splits, different splits, so on and so forth. And this is usually done quarterly or annually, right? Sometimes monthly. And S corp distributions skip self-employment tax. All right, C corp dividends face double taxation. You got the corporate tax and then the shareholder tax. All right, let's talk about salaries, also called payroll. Right, salary is simply a steady paycheck run through payroll. Right, if you ever had a job before, you know how this goes. All right, it's a fixed amount paid bi-weekly or monthly with taxes withheld automatically. Okay. Now, a salary is required for LLCs taxed as a corporation and if you're a C Corp founder. Now, this salary is subject to income tax, subject to payroll taxes, and the company also pays the employer portion as well. Okay. Moving on to choosing your payment type. You choose your payment type based on the entity that you are, right? The entity type decides the cleanest method. If you're a sole proprietorship or LLC, you do a draw. Do not do a salary. Okay. It's just wrong. It'll lead to payroll tax headaches and nightmares. If you're a sole proprietorship or an LLC, not taxed as an S Corp, then take a draw. If you're an S Corp, you're going to do a reasonable salary plus distributions. If you're a C Corp, yep, salary and sometimes dividends, right? And just as a quick tad bit, when do you move from an LLC not taxed as a corporation to an LLC, say, taxed as an S Corp? Well, that's after $60,000 in consistent net profit, right? Anything under 60,000, you're just going to be overpaying for the complexity and the ROI is not there. Okay. Step 3, how much to take. You want to start small and test the stability of your business before you start taking out just chunks and tons of money, right? You want to begin light and prove that the revenue actually holds. So your first payment, this is an example, maybe $500 to $1,000 a month, regardless, right, of what your business brings in. Once again, when you're starting, you need to test the stability of the business and the revenue and the profit. After 3 steady months, you can raise it a little bit. If income dips, you cut back fast. All right. And you want to raise it only after consistency. Don't raise the pay because you like to and you feel like it. And I think now is a good time. You raise it only if revenue is consistent for 3+ months. Or when you've grown the 1-month buffer, at least have that buffer in there. Now, when do you reinvest in the business versus when do you pay yourself, or when do you do a combination of both things? Because every dollar can go to you or to the business, so you need to choose wisely. Well, here's kind of how I like to look at it. If you're early stage, you want to lean toward reinvestment. All right. You want to put money into the business so you can scale that revenue, right? And see it consistent month over month. If you're mid stage, you might want to do 50-50. You got some consistent revenues, but you still want to scale, right? At later stage, you pay yourself fairly and distribute the profits. Maybe you got it to a stable place. Maybe you don't want to scale right now, all right? You can do that. But the goal with all of this is to not starve either side, all right? You want to grow the business maybe. You want to pay yourself, definitely. But you don't want to starve either side. You need both. What that percentage split is will depend on you and how you want to run your business. Now, step number 4 is setting it up and how to set it up properly. Let's first look at the draw, the owner's draw. It's the easiest of them all. And it's easy if you separate the accounts, which you should. You should have a business bank account and a personal bank account. So here's the steps. You just transfer from your business account to your personal account. Do it on a set schedule if you can. You want to track in your books as that payment being an owner's draw. Pay your quarterly taxes, right? And reconcile a year end. That simple. Owner's draw, piece of cake. Next up, we have distribution setup steps. It's more formal than the owner's draw, but it's still straightforward. You want to close your books monthly, right? Or quarterly, however you depend to do it. You want to confirm your true profit. You want to check 1 month buffer, right? Check your buffer. Allocate by per ownership percentage, and then document approval and transfer the money over. All right, that's how you do a distribution. For salary, here are the steps. Only 6. Not complicated, but more involved, right? You got to pick a payroll software. You got to decide your gross salary. You need to register for your state accounts. You run the payroll in that payroll salary, biweekly, monthly. That payroll salary will withhold and remit taxes, and you simply just record the approval. That's it for the salary. Now, I want to talk to you about health and retirement. When you first start out, some people don't think about this at all. And the truth is that you don't want to overcomplicate it too early. When it comes to your health, take stipends or small plans once profits are steady. When it comes to your retirement, you want to use a solo 401k or a simple IRA. Those are retirement accounts for business owners once that net profit is consistent and stable, right? You want to add benefits only after it's consistent. Now, let's talk about the mistakes that I see founders make every day, but it's not going to be you, right? Let's look over some pitfalls to avoid. When it comes to your taxes, don't get caught slipping, okay? The IRS is not a big fan of unorganization and being late, okay? So set aside taxes before you pay yourself. The rule of thumb is 25 to 35% of your profit you want to put away for taxes, just in case. Your payroll, the software should withhold your taxes automatically if you're running payroll. Draws and distributions, you pay estimated quarterly taxes on that. So the easiest fix is simply to move a percentage into a tax account as soon as your cash arrives. Right? As soon as you have the profit, move it over to a tax account so you don't forget. I can't tell you the horror stories, right, of people making, it don't even matter the amount, millions, right? And forgetting about taxes. And when that tax bill hits, the shock, the awe, right, the horror begins. The next big mistake is starving the business. As we talked about earlier, you don't want to treat your company as a personal ATM. Now, we are in business to make money. At least I am, right? But you can't treat it like a personal ATM if you can't afford to. So pulling out too much leaves no cash for growth. Pulling irregularly confuses your accounting, right? Your books, right? And the fix to all of this is to set a modest and predictable pay schedule. And there you have it. That's how to pay yourself. If you have any other questions, leave them in the comments. But as always, my name is Keran, and I'll see you in the next video.